How you calculate your taxes on your Social Security benefit. Stay tuned for the whole thing, my friends. This is so critically important. It should get you set up for your be poor on paper when you retire, because that's what you got to do. I tell you, man. All right, so let's dive into this. We're going to start with Right Capital. Hold on just a second. And what we got here is we got Scott and Susie Sample. And I'm going to share with you a single person here in just a second, because I know a lot of you say you don't focus enough on single people, but I do. I got Scott single, got I got single Scott, Susie single, something like that. But anyway, all right, so let's go. You see they got nothing. They got no assets, no nothing. All they got is income. It's going to be Social Security. So Scott is going to turn 70 at the end of this year. 12/31. What was his birthday? 12/31. 1951 is his birthday. So he will be 70 on the 1st of January of 2022. And when he turns 70, he will get a benefit that's 24% more than this. $3,200 is his PIA. I'm not going to go into PIA right now, but it'll be roughly $4,000 a month. His wife, Susie, is going to do the exact same thing. Ironically, she was born on the exact same day Scott was and has the exact same amount of Social Security benefit. So her benefit, because of delayed earnings credits, will be about $4,000 a month as well. So that's $8,000 a month between them. All right. Now, on top of that, there's going to be a 2.4% COLA as well. So what we'll see here is when they take their Social Security, they will be getting. All right, I want to come back to this. At the end of next year, they'll have received $101,000 of Social Security. Now, notice no taxes whatsoever and no net flows, because they're saying we're going to spend whatever we get. We're not going to save. We're just going to spend whatever we get. And so basically, they're consuming it all, which is why this is so freaking silly. There's no probability of success. Yeah, there's no probability of success because they're living off $100,000 a year and they're spending it all. They're still living pretty large. But anyway, no tax payments. You see that? None whatsoever. So let's go to tax. And you can see, other than at the last couple of years right here, they only pay 0.5% in federal tax. That's it. So no big deal. So I won't go to details. So here's their first 1040 in 2022. They have 101,000 coming in, and only 11,000 of that is subject to taxation. You factor in the $27,000 standard deduction, and their taxable income, which is line 10, is zero. A lot of you ask, what about this qualified business income deduction? Sometimes you're going to have that. That is for personal. In fact, we'll just go into 2028. They don't have, it's still the same thing, qualified, it's QBI, qualified business income. That will turn back to personal exemptions once the Trump tax bill goes away. So I wish they'd say qualified business exemption or personal exemption, but there is no personal exemption right now. It's all standard deduction. Notice the standard deduction dropped. And right here we go to 2026, actually 2025, I guess the last year. There's a standard deduction of 29,000. We go to 2026. There's a standard deduction has dropped to 16,000, and the personal exemption is 9,000. So we're much better off in the Trump tax bill for middle class people, unlike what the Democrats say. Anyway, so they're paying no tax on Social Security. And a lot of people say, whoa, they're making $100,000 a year, no tax, because it's all Social Security, all tax free. So you're going to say, how does that happen, Josh? Well, we're going to read you straight from SSA.gov. Some of you have to pay taxes, federal taxes, on your Social Security benefits. This usually only happens if you have substantial income in addition to your benefits. Substantial income would include wages. Well, most likely you're not working. Self-employment, most likely you're not working. Interest, you're probably not getting much interest. Dividends, probably not getting much dividends. And other taxable income that must be reported on your tax return. IRA distributions, that's the big one right there. You will only pay 85% a tax on 85% of your benefits max if you are an individual, a single taxpayer, and your combined income, hang in there, I'm going to explain this, so hang in there. Your combined income is between 25 and 34. You may have to pay up income tax up to 50% of your benefit, but if your combined income is over 34,000, up to 85% of your benefits may be taxable for single people. If you're married, between 32 and 44, if your combined income is between 32 and 44,000, 50% of your Social Security benefits might be subject to income tax. If your combined income is over $44,000, up to 85% of your Social Security might be subject to income tax. But if we go back to Right Capital, we say, wait a second, $111,000 in 2026 and no taxable income. Their combined income is well above $44,000, is it not? No, because we got to see what combined income actually means. Is your total adjusted gross income, your total AGI plus your municipal bond income, which is why I say don't invest in municipal bonds. It doesn't make sense. And half of your Social Security income. That is your combined income. All right. So in this case, going back to Right Capital, their combined income is not their total income. That isn't combined income. This right here is not what Social Security is basing its taxation on. What we have to figure out is what their combined income is and what we would call provisional income. So in this case, we're going to say we take simple. They have no income other. Let me just put this up higher. They have no income other than Social Security. So for just simplicity, we got we're just going to say $100,000 of Social Security benefits. We take half of that. That means they have $50,000 of Social Security benefits. All right. We're going to figure out what their combined income is. They have $50,000 of Social Security with no other income whatsoever. Now we know because they're married filing jointly that they don't pay any tax on the first $32,000 of combined income. None. There's no taxes due on the first $32,000 of combined income. All right. Now we also know that $32,000 to $44,000, 50% of that amount is subject to taxation. So we know that they have $12,000 in this second bend point here. So that's going to be 12,000. All right. And then we know anything over 44, 85% of that would be subject to taxation. All right. So we know for a fact that they have no income. None of their first 32,000 is subject to taxation. The next 12,000, 50% of that is subject to taxation, which is actually $6,000 because 12,000 divided by 0.5 is $6,000 bucks. Now they got 6,000 because they have 50,000 total combined income, 6,000 above 44,000, and that is subject to 85% taxation. So 6,000 times 0.85 is 5,100. So that's how much of their Social Security benefit is subject to taxation. It's about $11,100. If you look, again, I'm using $100,000 here. So if you look at the 1040 on their, let's go back into Right Capital, you're going to see their taxable Social Security benefit was right there, $11,685. And I had $11,100 because I used $100,000 for simplicity, just simple math for a lump of coal. But that's not their taxable income. That's not their taxable income. That just adds to their other sources of income, which you can see here is none. But remember, their AGI, you reduce it by their standard deduction in which to get their taxable income. So you reduce the AGI by the standard deduction, and that will give you your taxable income. And that's what your taxes are based on. So they have a AGI, your total income is $11,685 minus their standard deduction of $27,800, and they have no income taxes to pay because their standard deduction exhausts any of their AGI. There's no taxable income. Hope that makes sense. All right. So what we're going to do, we're going to eliminate Susie here. We'll just go to Scott. Hold on a second. So now we got Scott's sample. He's single. The same thing is going to happen. He just has one less Social Security because old Susie's gone. All right, so we're going to see cash flows. Exact same thing. Now he's got $50,000 of Social Security. Let's just do this exact so we can get a gauge of this. Now for a single guy, his combined income is not $50,688. You got to divide that by 2 because the Social Security is his only income. You got to divide that by 2. $50,688 divided by 2 equals $25,344. 25,344. Now again, this is just living off Social Security. All right. we know for a single guy, the first $25,000 is not subject to any taxation whatsoever. The first $25,000 of your combined income. So the first $25,000 is zero. So he only has $344 that is subject to taxation, and that's only going to be for 50%. So next 25 to 34 is 50%. In this case, it's only 344. And we divide 344 by 2, he'll have $172 of taxable Social Security. That's it. Crazy, huh? So let's go and look, see if I got my numbers right. Let's see what the 1040 looks like. I hope it does. I hope it looks right. Let's see. $172. Look at that. But trust me, I did not look in advance. It's literally that simple to calculate this stuff. You just got to know what I hate to say bend points, because bend points is something else when it comes to Social Security. But so 170, so he's got 50,000 of Social Security income. Only 172 is subject to taxation. That's his AGI, 172. But he's got a standard deduction, 14,000. His taxable income is nothing. All right. So now what we're going to do is we're going to come back and we're going to add his IRA, and we're going to add it into the plan right there. All right. So we're going to include this in the plan. And he's got 200,000 in an IRA. Now watch what happens now on his taxes, because now he's gonna have to start pulling money out. Oh, now you can start seeing it goes up a little bit. Look at that, pretty interesting, huh? Now why is that? Well, it's gonna be simple. So we're gonna go to retirement, and in 2000 we're gonna go to cash flows, and in 2000 and we'll say right here 2021. Now let's go down to where he's got some taxes. Right here, 2030, he's got $61,000 of Social Security. Now it's just half of that 61,000, 61,277 divided by 2, plus his RMD, 11876. All right, so that's how we factor in what his combined income is going to be. So we got 61,277 of Social Security divided by 2. That's 30,638. Plus is 1176. All right, so we got 30,638 for Social Security. 30,638 plus is 11.7. Wait, what did I say for his RMDs? 11. Let me say we're 1176. 11,876 plus 11,876. All right, 11,876. So basically, you take it, whatever your other income is, municipal bond, tax-free is part of this. Any income you get from interest, dividends, capital gains, you name it, is part of this, plus your required minimum distribution. So we add these two up, and that will give us his combined income, 11,876, 42,514. That's his combined income, 42,514. All right. It's the same calculation as before. 42,514. The first 25,000, nothing. The next 25 to 34, 50% of that. The next amount over 34 is 85% of that is subject to taxation. All we're trying to figure out is how much of his Social Security benefit is subject to taxation. Notice, this is 3 years from now. And notice these numbers haven't changed. 0 to 25, 25 to 34, and 34. These haven't changed since 1983. Those freaking rat finks in Congress, man. They did not inflate the Social Security taxation numbers. So more and more of us are paying, in fact, the vast majority, a large majority are paying taxes on the Social Security benefit. It's a freaking clown show. All right. So we got 42,514. The first 25,000 is not subject to income tax. The next 9,000, 50% of that is subject to tax, which is 4,500. And then we got 42,514 minus 34,000, which means 8,514 will be subject to income tax at 85%. 0.85, which is 7,237. All right, 7,237. So what's happening here is you take 42,514. There we go. 42,514. You subtract $25,000. You take the next $9,000, all right, you times that by 50%, so it's 4,500, because we know any amount of combined income that's between 25,000 and 34,000, 50% of that is subject to taxation. Then you take whatever's above 34,000, which in this case is, I can't remember, 8,000 something, and you times that by 85%, and that's going to be 7,237. And you add the 7,237 plus that 4,500 to get your total amount that's subject to Social Security that's subject to taxation. 11,737. 11,737. 11,737. So of his $42,000, of his, I can't remember what was the Social Security benefit, I forgot. But anyway, of his total Social Security, let's see, his total Social Security benefit was 50, right here, 61,000. Of his total Social Security benefit, 61,000, only $11,000 is subject to taxation. 11,737. But we're not done here, because he still has to add that. Half of his Social Security, I mean his taxable Social Security, 11,737, plus his other income. In this case, his other income is his required minimum distribution of 11,876, right? Yeah, 11,876. So we add these two together, and it comes to 23,613. 23,613. And now we know how to figure this out. I just can't remember what the standard deduction is. And I can't remember, I don't know what it's going to be in the future, because the tax brackets are inflated. So we know his AGI. We know his AGI is going to be 23,613. So let's see if I'm right. All right, we're going to go to taxes. We're going to go blink, and we'll see exactly where we are. We're going to go to details, and we got 2026. Is that what it was? What year was that actually? I forgot. What year we at? Retirement, was it 2026? 2020, no, it was 2030. All right, 2030. So let's see here comes the moment of truth. I have not done this in advance. It's 2030. So let's see if I'm close. Yeah, there we are. So basically his 100%. So his Social Security, 61,000. And see, they're getting him some qualified dividends. I did not do that, so I'm going to be off by a couple bucks. But anyway, 61,277 is the Social Security, of which 12,960 is subject to taxation. I had 11,737 because I did not add this qualified dividends, because I forgot to have them spending all the money, and we have it reinvesting, which I wish they would not have done that. But be that as may. So I'm pretty doggone close. So his total income, 26,276. All right, 26,275. I had 23,613 just because we can just even go. All right, we'll get it right to where I was, so I can prove to you I know what I'm talking about. Eliminate so basically what's happening here is he's reinvesting his saving, what he's not spending. I don't know how to eliminate that. It's weird. So you see his net flows. The 7,700, 8,200, 8,800 is actually going back into his taxable account, which I wish I didn't do that. So every year he has that's not what I'm talking about, net cash flows right here. Every year has net cash flows, and I don't know why I can't eliminate that. But either way, it's adding to his income, because he has dividends and capital gains from it, which I wish it did not have, but whatever. Still pretty close. So anyway, so we go to 2030. And you can see he's got $26,000 of total income. I had him with $23,613. And that's what's interesting, by the way. That extra $1,400 did not just add right there. The $1,400. So if you take these numbers right here, so let's just run this real quick. 11,876 plus 12,960 equals 24,836 plus 1,436. Yeah, there you go. Okay, good. It did. All right, so I wish I didn't have to have these ordinary dividends there, but because then I would look so smart to be spot on. Be it as may, it is right there. So with that RMD of 11,876, that makes his total income $26,000, his AGI. But he only gets $13,500 basically between his standard deduction and his personal exemption. So he has $12,000 of taxable income. Now again, he's living off $12,000 here plus 62,000, 61,000 there. So he's living off $73,000 and he's paying all of $1,000 in income tax. That's still pretty good. But that's the issue with required distributions. It makes you have more taxes to pay. I mean, look, I'm not arguing with that. It's no big deal. But again, that RMD changes everything. We want to try to avoid those if we can. And the way you do that, let me just show you how this works. If we just change that one account from a taxable account, from an IRA to a brokerage account, and we even have to have a cost basis. So watch this. I probably should have done that to begin with, actually. Probably. Well, let's see what happens. I'm not sure what's going to happen here. All right, we're going to go to taxes. We're going to go to 2030. Yeah, there you go. So we got my 2030. Yeah, right here. So 2030. Yeah, right on. All right, so he's got 61,000. He's still got the qualified dividends. I wish it wasn't. I wish I'd have qualified dividends. I didn't do what I was wanting because now we don't have the RMDs. All right, so without the RMDs, where I'm going with this here, we only have a tiny bit of qualified dividends. We got $61,000 of Social Security, of which only $2,000 is subject to taxation. Add the $44 of qualified dividends, a little bit of tax-exempt interest, and you have $2,900 of gross income. Subtract your your standard deduction, your personal exemption, you have no taxable income. So check this out. So look at that. We have $61,000 with no taxes whatsoever. We go back to make this portfolio an IRA, and we're going to make it right there. And now we have RMDs, and it's going to change everything because the RMDs will make your Social Security subject to taxation. I hope this is making some sense. But here we go. Now we have RMDs of $10,307 plus $20,000 of his Social Security is subject to taxation. And you can see now he's got a little bit of tax. Not much. I mean, not much to worry about. But the point being is we want the bulk of your income to be Social Security so you can be tax-free. Because once you figure out how the tax code works with Social Security, man, it just changes everything. Remember, the combined income, aka provisional income, all that is saying is how much of your Social Security is subject to taxation. You take half of your Social Security plus all of your other income that you have. You add those together, and if you're single, the first $25,000 is tax-free. So if your total combined income is less than $25,000, I guarantee you're not going to pay any taxes. But even if you have over $25,000, the next $9,000, only 50% of that is subject to taxation. That's only $4,500 max. The next amount over 25 to 34, 85% of that is subject to taxation. So once you start getting bigger and bigger with large RMDs, then your entire Social Security will be subject to taxation, 85%. But if you can keep your combined income low by having a big Social Security and limited amounts of required distributions, man, you can have tax-free income for the rest of your life with a cost of living adjustment. I hope this helps. Love to hear your comments. I know there's a lot going on, but man, you got to know this stuff. All right, we'll see you guys.